Hello, welcome to Forex School Uganda. I am Godfrey. Today I want us to talk about how to trade, especially for those that have full-time jobs and they do not have the time to focus on the charts, but they would love to take up trading as either a craft for a side income or potentially in the future as a full-time income earner. So I would like to take us through what strategies you could use to trade to be able to hold on to your job as well as function as a trader in the Forex market. So before us here is the daily time frame, which is ideal especially for those that have full-time jobs and don't have the time to day trade or to do bits of scalping here and there. The daily time frame would be very ideal for such people to do trading as a business. The fact that you'd only have to be checking the charts once in 24 hours, and that is at the very end of the trading day. You only check the charts once there's a correct setup for you to trade. You set your trades and you forget about them to come and check again whether you made money or you lost money, or maybe just to manage the trade in the sense that once it has moved a certain number of pips in your direction, you can then adjust your stop loss to break even and let it run. So this is the daily time frame, and when you look at it, you will see that price had been consolidating between these highs and lows, and so all this is a consolidation area. You can see that price has been consolidating between this low and this high, came back, retested this low right here, then retested the highs, came back to the low, then the high, the low again, then went back to the high, and finally came back to retest these lows, and this time it was able to break below the consolidation zone. Now when you look to the left to this range here, you can see that it is a pure range, a clean range, where price had no hesitation moving from the downside to the upper side with no areas of resistance or support formed during this move to the upside coming into this consolidation area. And so this clean range would be a very good zone for us to target, knowing that price wouldn't face much resistance as it is moving to the downside should we be hoping to be taking sell trades in the market. So that is a factor to consider. So we would need, first of all, this range right here. We would need the market to be ranging. Then you would need this clean range to the left. Then we need price to break out below this range. And we need price to retrace, to come and retest this broken out area. And the reason for the need for the retracement and retest of the broken out area is so that is to avoid fake breakouts and to be sure that the break is for real, it is genuine, and it's not a fake one. And so that's precisely what you'd have to wait for. So you come to the charts at the end of the day and you see that price broke below this support area, retrace to come and retest this support now turned resistance area, and it closed with a long rejection candle that is commonly known as a pin bar or a hammer candle. Now once you see that, it is time to prepare yourself to take a trade. However, you don't take trades from charts in isolation. You need to look at the different higher time frame charts, analyze the movement of price at the moment, the momentum of price, and to know the higher time frame direction away from the chart, separate from the direction you're seeing in the chart that you intend to take the trade in, because you need a confluence of factors to inform your trading. And so a higher time frame confluence in sync with the lower time frame price action that you intend to take your trade in would be a good idea. And so this being a daily time frame, we would need to check the immediate higher time frame, which is the weekly, as well as the higher time frame after that, which is the monthly time frame. But for now, let's first analyze this daily time frame. When you look at this, you see that we had this breakout to the downside, followed by this retracement to come and retest this broken support now turned resistance, and we see that price closed with a long rejection wick that we know as a hammer or pin bar, indicating rejection of higher prices and a bounce of this resistance area and a potential continuation to the downside. And secondly, you realize that this is an impulsive move to the downside, that was formed by strong momentum candles moving to the downside, followed by this correction to come into this support now turned resistance area. And so after an impulse and correction, what do you expect to see? We expect to see another move to the downside, an impulsive move to the downside, to complete what we know as the impulse correction and impulse formation in the market. Secondly, what we'll do is to use our Fibonacci tool and measure this impulsive move to the downside from the high to the low of the move, and you realize that price is currently testing and rejecting the 61.8 golden Fibonacci ratio, which is a strong rejection level. And you will again realize here that it is actually closing not only below the 61.8 but the 50% retracement level as well. And so the confluence of these two Fibonacci levels, as well as this support now turned resistance level rejecting price to the downside, gives us a strong indication of price rejecting higher prices and a potential move to the downside to be expected in the market. So we'll look at the weekly time frame to see if we have higher time frame confluence for bearish moves in the market. Now, looking at this weekly time frame, we see that price also had this consolidation phase in the market before finally breaking below and closing below this support area or the low of the consolidation phase, which means that the momentum coming into the market right now is bearish. And so that, in confluence with the daily time frame, we can tell that we could potentially see bearish moves in the market. Now, you'll also realize that this candle here closed not only bearish but also with a long wick to the downside. Now, when you look at it closely, you can tell that the next support area is way down here. So this wick is not touching this support area, and so we couldn't call it a rejection wick, but rather a wick that should be filled by price. And so it should act as a magnet for price to the downside. Since there's no area that we see that it is bouncing off, you would say it was bouncing off this resistance area here. However, at this point here, you can see that it was able to close below this level here. And so it's not a rejection wick, but rather a wick that should see price attracted to it, pulled to the downside, and cause bearish moves in the market. So coming back to the daily time frame, we have our setup ready, which is this breakout and retracement to retest this broken level with a bearish close and a long rejection wick to the upside, indicating rejection of higher prices and potentially bearish volume coming into the market. And so what we do is setting our sell stop order right here with a stop loss at the high of the candle, this rejection candle, and the entry is at the break of the low of the rejection candle, and our target would be the minus 27%, measuring from the high of the retracement to the low of the retracement where the retracement began. And we can see that the minus 27 level is down here, and so marking it off right here with this tool of ours, we'll extend our target to this point here for about 2.8 risk reward ratio on this trade. And now this is the setup that is still running at the moment, and if we play it forward so you can see where it is right now, you can see that price is currently still running, and it hasn't yet reached this take profit area, and hasn't yet reached this take profit area, but it reached a 1.5 risk reward level. But that is not the target. You let it run to its full target. Remember, this is about setting and forgetting, and it's ideal for those that don't have the time during the day because of their full-time occupations to be able to monitor the trade. So you set and forget. So we set a sell stop here. When price was moving to the downside, it logged us into the trade, and currently price is running, and hopefully it comes to reach this TP or the take profit area that we have marked out right here. So this is still running, but you can see that there's a clean range to the left, and so that's why price was able to flow smoothly only issue we are having is the fact that there's a support area right here, but we'll see how this candle closes at the end of the day. If it closes below, that could be an indication of a bit of rejection happening at this support area, and so that could mean taking out some of the profits, then moving your stop loss to break even and letting the rest of the trade run to the full take profit area. So that's it for today. If you're one such person that doesn't have the time to keep monitoring the charts all day or looking for intraday opportunities, this is one of the trading styles that you can take up. It is very convenient, it is very profitable. You don't experience so many whipsaws that happen in the lower time frames, because remember, you're only trading the daily time frame, and so you only need to check once. Now that will help you avoid over trading, and it's also good for your emotional health, since you only have to check once a day and you don't have to go through the emotions of the trade running back and forth, since this is a set and forget style of trading. I'll be coming again with more gems on the channel, so stay tuned to the channel and look out for more educational content that I'll be posting every once in a while. But if you're new to the channel, kindly subscribe, like and share this video, and also remember to turn on the notification so you're alerted every time I post new content on the channel. Thanks for watching. I will see you again.